Eurozone finance ministers once again delaying the decision on whether Greece will get the next instalment of its bailout cash. Greece had previously said that it needed the money by mid-October to avoid defaulting on its loans. But it now looks like it won't get its next loan tranche until November. Well, the Eurogroup chairman, Jean-Claude Juncker, has ruled out the possibility of a debt default by Greece, denying rumours that some countries, including Germany, had been pushing for this. Well, the meeting also appeared to reach a deal to let Finland receive collateral as security for its contribution towards the Eurozone bailout fund, the European Financial Stability Facility. Well, for more on what all of this means and the implications for the euro and the rest of the central bloc, we can now speak to the head of global economics from Barclays Capital, Julian Callow. He joins us from his office in London. Julian, thank you very much for joining us.
Hello, yeah.
And first of all, let's look at what happens to Greece if that next tranche of aid doesn't arrive until November. Is it safe until then?
I think the situation is just going to be a very nervous one, and the more that this is not resolved, then frankly I think the more that the market anxiety is going to really build up and potentially feed on itself. Of course, Greece can still get by issuing some T-bills. In fact, the big Greek debt redemption is not due until the middle of December, so that's really the point when they really have to have the money to pay off that large redemption without undergoing a default at that stage. But the message clearly that's been brewing away, really, the flavour of it came out a little bit, I think, at the IMF meetings, and it's implicit in some of the Eurogroup comments, is that the Greek programme has been going, of course, despite the July initiative, when of course we were all glued to our screens and watching the votes in the Greek Parliament. Quite simply, the global economy has slowed down, the European economy has particularly slowed down, and for a country that's having the worst of the activity, in other words Greece, that's contracting sharply, it's now contracting probably at a quicker pace than it had been, and this is really throwing awry all the calculations that have been made about meeting its deficit target for this year. And with that then, clearly opposition has been building up in Northern Europe, particularly in Berlin, to what really was agreed at the July 21st summit, and you have this need to reconcile opinion, and hence the hints that the PSI agreement might actually be reopened again in some respects, even if only on so-called technical basis, really.
Let's talk a little bit more about the PSI. It did seem to be that after what was said in Luxembourg, investors could expect to have a greater role in the bailout. We don't, though, know, will take some kind of haircut. But what more do we know about the detail?
Well, I'm not really aware of much more than that, as you say. I mean, I think one thing is clear, that there could be significantly more in the form of debt buybacks here. Now, I think the EFSF would have to be playing an important role. It would have to raise the funds, and then it could engage in debt buyback auctions, and that could be very significant, because if you're looking at Greek 10-year debt, for example, that's trading around 33 cents, clearly there's actually a lot of potential debt relief, I would argue, that could be secured here for Greece if we went down that route, provided it was structured in a way that didn't immediately lead to a significant rally in the price of that debt. What I think the Europeans have to be very careful about here is precipitating some kind of major credit event, in other words a hard default here, triggering CDS. Although I think a CDS trigger in the case of Greece by itself could be handled by the financial sector, the problem is that it would send yet a further negative message, which would be another wave of contagion, really, I believe, across European financial markets. So if you went down the buyback route, possibly there are some other ways in which the July 21st agreement can be amended in terms of lengthening further the duration of the debt that's being part of that. Then this certainly would be preferable in the current environment. But at the same time, I can imagine well that the Greek government is really throwing up its hands in despair here and saying, well, we really are at the limit of what is politically feasible to achieve right now in the case of Greece, because our economy is effectively imploding here. So it's a big battle that's going to take a long time to resolve, I believe.
No, you mentioned the contagion concerns if there was a credit event triggered by what's happening. Italy has now surpassed Spain with regard to the market concern, yet on other factors, for example, and other measurements like fiscal consolidation, it's actually in better shape. Why is Italy to the fore?
Well, I think the fact is that suppose we were to have a major Greek haircut on Greek debt, so you cut the ratio, which at the end of this year is heading to 155% of GDP, you cut it all the way down to 80% of GDP, say. Well then, who's next with the highest ratio? Well, it's Italy at 120%, and then Ireland is coming up quite fast behind. So I think the markets are now very much fixated on debt to GDP ratios. Of course, that they should be more sophisticated and look at the whole issue of the deficits and the debt dynamics and the growth potential and the interest rate. But effectively, looking just only at debt GDP ratios, then the markets are going to zero in that scenario on Italy and Ireland in particular. And Spain, meanwhile, has a very low ratio, particularly of net debt to GDP. At the moment, the net debt GDP ratio for Spain this year is heading to be about 55%, so really very low, even though it's got a big deficit problem there.
Okay, Simon Callow from Barclays Capital.
Julian.
Thank you very much indeed for Julian Callow. I'm sorry. Thank you very much indeed for joining me.